Good afternoon, everybody. I'm getting a real echo, I think, off Dan's speakers. Miles, funny you should mention the hair thing, because we have had a discussion about when are the barbers opening. I've got bangs for the first time since I was about 12, and I think other Dan that you can see on screen has got a lot of hair longer than he was when he was an undergrad. So we have actually had that conversation in the green room. So listen, I'm going to not talk very much today. One, because we've got a pretty full agenda and we're likely to run out of time. And secondly, I know when I'm completely out of my depth. So I'm going to do the two intros for our main speakers up front, so we can do the transition between the two of them quite quickly. So on screen with me now is Dr. Daniel Philps. He's Head of Investment Strategy and Partner at Rothko Investment Strategies. They're an institutional investment manager driven by artificial intelligence, specializing in international and emerging equity strategies. So a PhD in AI, something like that probably didn't exist a number of years ago, not that many years ago. But it's how AI can be used to learn and shape a systematic investment management approach. So he's also the architect of a new AI-driven ESG performance scoring and measurement system called Gaia Lens, which I'm sure he'll talk about at some point. And then the second speaker is Daniel Bland, Head of Sustainable Investment Management at responsible investment specialist advisory firm EQ Investors. Daniel will focus his session on how ESG ratings largely deal with corporate behavior when investors are generally more pragmatic in thinking about how the end product or service they want. This mismatch means investors have to be careful with ESG labels, and you can get a very wide range of outcomes. So two really interesting topics. We've left quite a bit of time at the end for Q&A, which our own Adrian Balding's going to chair. So I'll introduce Adrian towards the end of the session. But for now, Dr. Dan, over to you. Looking forward to your session.
Great. Well, thanks very much for that intro. Thanks to Dunstan Thomas for hosting, and Adrian Balding as well. I'm going to set the scene. ESG investing. We all know a lot about it. There's been a lot in the press, but I'm going to set the scene. Talk about what I've seen of ESG investing from an institutional standpoint and how that relates to the opportunity that's available to use the vast amount of data that we're now seeing being generated to keep tabs on the ESG profile of companies out there. And then we're going to dive into a bit more detail about how AI can actually be used to form a better view on an ESG profile. So that's going to be about sort of 15 minutes in all. So the first sort of element is, what are the, what's the current lie of the land with respect to ESG ratings and ESG investments? Well, we all know that there are a lot of issues with the way things are currently set up, and what we see today is going to be very different to the way that ESG investing actually settles in many years to come. And there are lots of precedents for this in the investment world, where a loose sort of definition, loosely defined concept becomes sort of firmer over time. And I'll sort of point to 5 areas where ESG investing isn't really working that well for people at the minute. And the first is that ESG ratings particularly are a one-size-fits-all. Rating agencies generate a generic, essentially virtue ranking for companies, which doesn't seem to have much of a relationship with investment risk from my perspective anyway. And those ratings tend to be pretty subjective, and they tend to be inconsistent as well over time, over sector, over geography. The second element is that there are a huge number of data resources that are available to us now, and it's really difficult for a team of human analysts to digest that information and come up with consistent and objective views on companies, given the amount of data that we're talking about. And so that's a real problem, how to lever that data, and that's where the big data and artificial intelligence comes in, of course. The third element is CSR reporting, the reports that companies generate in their CSR reports, or the comments they make on sustainability, are pretty inaccurate. They can be missing information, they can be erroneous, and frankly, companies can make stuff up as well, as we're all aware. And it's difficult for human beings, teams of analysts, to spot these things when there are so many companies to review and so many data items that they're going to have to review as well. It's where technology can really come in and make a difference. The fourth element is measuring ESG investment risk, and I stress the word investment because ESG has become a sort of world of, as I mentioned, virtue ranking. And it's all very well to point out virtuous companies, but as investors, we also, and perhaps primarily, want to understand how changes in the environment, changes in social regulation, failures in governance are actually going to affect our bottom line, the returns that we're generating. And ESG needs to refocus. Rather than being about virtues, it needs to focus, in my view personally, on investment risk as well as virtue. The fifth element here is about materiality. And SASB have done one of the organizations involved in the patchwork of NGOs, voluntary organizations, regulatory organizations, and so on, supranationals. One of those organizations, a very good organization, I would say, has tried to map out which of the ESG themes are material for different companies. But it's a pretty rigid way of thinking about it. A lot of it won't change over time, but clearly, because companies are involved in corporate actions, they evolve, they change. It means their business profiles change, and what might be material for a particular company today might not be a material theme in the future. And material themes I'm thinking about, it could be data security, which might affect a telecoms company more than it would a utility, perhaps, or carbon emissions, which obviously would affect a utility more than it would a telecom, and so on and so forth. So what are you looking at in the ESG profile of a company to assess it? AI can really address each of these different elements, these different challenges, if it's applied in the right way. And we're going to come on to that later in the presentation. But first of all, in terms of the ESG backdrop, let's just have a look at where things are at the moment. And I've used a selection of really good exhibits that other people have put together. There's no point in reinventing the wheel. And you can see here that in terms of the ESG funds landscape, it's a huge landscape now. Estimates of around $40 trillion assets under management globally, with Europe leading in terms of the size of assets under management. So Europe is the largest sustainable funds market in the world as we stand today, and it made up something like 40% of the inflows into funds in Europe went into ESG funds last year, something of that order, according to Morningstar. It's notable that active management makes up the vast majority of assets under management in ESG and sustainable investing. And it perhaps isn't surprising, because assessing the ESG profile of a company feels like it should be something that's done on an active basis. And because of the challenges that are involved, that I've just run through, these 5 key challenges about the use of data, inconsistency of ratings, subjectivity, all of these different things that would tend to drive passive investment strategies. All of these things provide a massive challenge to passive as well as active. And to solve these problems of subjectivity, inconsistency, and so on with respect to ratings would allow us to have a much, I would say, more powerful approach to driving passive investment, passive ESG investments. But we're probably not there yet, and that might be indicated by the AUM split between active, which makes up the lion's share of sustainable fund investments, versus passive. Well, let's look at some of the challenges in the food chain itself, the way that from an institutional perspective anyway, but it's similar in retail. ESG objectives can be lost in translation, because ESG should be, in my view, be driven by the asset owner. It's the asset owner's definition that matters in ultimately achieving their objectives. But at every step between the asset owner and the implementation of their capital, the allocation of their capital ultimately, there are elements of ESG that are lost in translation. So we start off with the asset owner, which they may or may not have a clear idea about what they believe ESG is. We assume that they do. Then you have investment consultants, IFAs, and so on. The investment manager probably has their own interpretation of ESG. You have all sorts of regulatory bodies. I mentioned SASB, the EU, supranationals, NGOs, and so on. And then you actually have the implementation at the corporate level. What sustainability actually means at the corporate level, and whether corporates are going to be engaged with achieving those sustainability ends. And it seems that there's a risk at every one of these stages that something's lost in translation. So if we look at how managers deal with ESG flavors in terms of the implementation of ESG strategies, and this is thinking about active equity strategies, there are 4 types of active equity ESG strategy that you can get, essentially. There's the negative screening approach, which is the old style of eliminating names and sectors based on rules, essentially, or preferences of the asset owner. ESG integration, which is probably the most popular form at the moment, as we'll come on to see on the next slide. Active engagement, where you're actually, as an investment manager, engaging with companies on particular themes that are important to you or your asset owner. And finally, the strongest form of ESG, which is impact investing, aiming to achieve a specific and measurable aim generally in the way in which you're investing and achieving those goals with your investments. And according to B Finance survey, this is the way that each of these themes are broken out in terms of the way that assets are managed at the moment, based on the respondents of the B Finance survey this year. And this is sort of interesting that something like 49% of managers surveyed don't use negative screening, which may not be surprising because things have moved on since the days of negative screening towards ESG integration. In other words, integrating ESG into your process, actually getting your analysts to consider the ESG profile of the company before coming out with a buy recommendation, for example. So something like 27% of managers are still not doing this, which is perhaps a surprisingly high number. And then we get more onerous with the active engagement and the impact investing, where fewer managers tend to do that than the ESG integration. So that sort of should give you a feel for the way in which the market's laid out, what people are doing and how they're doing it. But let's look at the passive side of things. And I think a cynical take on passive is that rather than actually trying to identify stocks with good ESG profiles or not, these sort of indices that we're seeing at the moment, driven by rules, ESG ratings, and all of the data behind the ESG process, essentially, it doesn't feel like it's reached a stage of maturity yet that would satisfy me personally as an asset owner and an investor. And what you can see here are various different flavors of equity indices. This is based on all countries, world, universe. So that's developed markets and emerging markets, market cap weighted. And you can see different flavors of those indices. So the sort of thick black line in the center indicates the standard index. So this in this case is the MSCI. But this, I'm not singling out MSCI here for criticism. It's just, I think you can point to any index provider, they have the same challenges. So the MSCI, ACWI is the central line here. You can see that the ESG leaders index that they have, and you could look at pretty much any flavor of index that any index provider has, to my knowledge, 90% of the indices out there look very, very similar to the standard index with respect to their returns. And actually, it's possible to reconstruct this ESG leaders index, the green line here, by simply tilting the standard index towards growth names. And this is a sort of cynical take on ESG at the moment, I think, from a passive perspective, that perhaps what part of what's going on here is just a tilt towards growth names rather than anything cleverer than that. And that should be a concern for asset owners. And again, it's driven by perhaps a weaker use of the data, which can be corrected by using more of this data and dealing with it more cleverly, I suppose. There's also the element of companies reporting the data availability out there, and these charts show the percentage of companies, large companies in the blue and smaller companies in the darker blue here. So the smaller companies at the bottom, which are reporting sustainability reporting to some extent. So these are the smaller companies globally across 52 companies in the KPMG survey done last year on this. And these are sort of larger companies across around 52 different countries. And you can see that the majority of companies are putting some sort of sustainability reporting in their annual reports, their CSR reports. But the problem with this is that there are holes in it. It can be inaccurate. It's highly selective. There are very few standards in place to govern what companies say or don't say, and the accuracy with which they say it. So the number looks high, but the reality hides the truth that there are some real issues with the data out there. And you can see how this sort of reporting is spread around the world. Just jumping quickly on though. But it creates an opportunity to do something better. And, we've got these inconsistencies, subjectivities, weaknesses in using the limited and perhaps patchy data that's available, even though that, the reporting might be more widely spread now than it was before. But there's a huge amount of data that needs to be levered to get a really objective view on what's going on. And I think artificial intelligence is one way of absorbing all of this information and doing something with it. So this section we're going to sort of get down into more of the detail. And again, there are 4 areas where we're going to focus on. The first one is that AI could be the basis to end the one-size-fits-all ESG approach that we have at the moment. A AAA rating for a company that a third-party rating agency would give you is an ESG defined by them to achieve their objectives, or at least anticipate what an asset owner's objectives might be to arrive at that rating methodology. And that doesn't seem to be sufficient in the current environment we're in, where people are having a better and clearer idea about what they believe their ESG is, rather than what the rating agencies might. So it's possible to use AI to sort of customize, to have a bespoke form of ESG, rather than accepting the one-size-fits-all going forwards. And things are going to evolve in the ESG investment space to achieve this over the next few years, in my view, particularly in the institutional space. The second element is to harness and interpret the vast data resources we have at our disposal now, which range from, as we'll come on to see, social media, news flow, NGO comments, and so on, right the way through, to all sorts of other information, satellite imagery and so on. And it's possible to harness all of these pieces of information to get a clearer picture of actually what's going on the ground. The third element is that it's possible to employ AI to validate the information that we are given. It's patchy, there are holes in it, the reporting standards aren't in place at the moment, and it's possible to engage machine learning and AI to get a deeper understanding of where those errors and inconsistencies might lie, and what the true values of those numbers might be for a company. And if you think about comparing two utilities and 2 separate companies that have a similar fuel mix, the chances are they're going to have a very similar sort of greenhouse gas exposure as well. That's a very simple example, but you can see that it's possible to what we would call impute, to work out the gaps in a particular company's, what the gaps in a particular company's reporting, whether they're accurate, how they should be filled, what we should assume about those companies. It's possible to use AI to drive some of that. The fourth element here is measuring ESG investment risk, and I stress investment again. Rather than a sort of virtue ranking, it's important for us as investors, or indeed as fiduciaries, to achieve the aims of our ultimate investors, and that might not be about virtues. That's much more likely to be about investment risks, and we're going to look at each of these different things. So firstly, in terms of the end of the one size fits all, it's possible to use AI and machine learning rather than taking a sort of pretty stylized version of someone else's ESG, rating agencies here, with sort of pretty static weightings for environmental, social, and governance drivers for an ESG rating, driven by materialities that a company might have, but ultimately a static way of thinking about things. That might not be our version of ESG. We might be more interested in the social performance of a company and less in the management of water resources, for example. That's perfectly reasonable. And why shouldn't you, as an investor and asset owner, be able to view the world through your lens rather than having to take a third party's pretty stylized lens on this matter? And it's possible to use AI to customize these weightings. So basically, to decide what's important to you and to have those weightings drive a more bespoke form of ESG rating. And we can clearly see how we're going to do this and have developed the technology to do this for institutional investors, certainly. For retail, it may be more challenging, but this is something that will evolve as the space evolves over time. So it is possible to change the balance of what's going into an ESG rating and to recast all companies, all stocks within an investable universe using an investor, the asset owner's objectives to form a bespoke view on the world and manage money according to that. And that can be done on a passive basis or an active basis. In terms of the huge amount of data that's available out there, to give you a feel for the way we tend to think about this, we think of it as being there being three sort of pillars of data out there for ESG or for investment more broadly. And the first one is the structured data: CSR reporting, ESG reporting, sustainability comments in financial reports, and so on. And that's useful. That could be helpful. But we're looking at what a company says about itself. And that's that may not be closely regulated. The way in which the companies are reporting is generally on more or less a voluntary basis, with very limited amounts of audit and so on that, if any at all, in many regimes. And so it's of a limited value on its own. The second pillar of data that we've got is big data. It's this vast trove of knowledge, this human knowledge that's available, encapsulated by the internet. And I'm thinking about NGO comments by people like Amnesty International, the news flow that we're seeing on companies and individuals that manage companies. I'm thinking about social media in markets like China, where Baidu is where Weibo is a very powerful source of information about company performance and what's going on the ground, and also other powerful insights that can be gleaned from this vast amount of information that's generated every second of the day, and will help us validate the information that companies are saying about themselves. In other words, it's about what people are saying about those companies. The third element, which isn't really talked about in the context of ESG much, but is really critically important, is good old-fashioned financial reporting. And this is the third pillar of our ESG data set. And it can be used to rebase all of this ESG information back into some form of economic reality. And so to combine all of these three pillars, you need to be using something smart. It's data overload. There's a huge amount of information, too much for a team of human analysts to digest and use in an objective and consistent manner in a vast investment universe. In my view, you need machines to be able to digest this information. We're now going to touch on the sort of concept of investment risk versus virtue. It's all very well to look at a company and say it's virtuous, but really, does that help us in terms of our investment aims and our asset owners, our clients, and ourselves as investors? We're aiming to achieve good investment returns, obviously, achieve our fiduciary responsibilities, whatever it might be, first and foremost. But make sure the companies we're investing in are doing the right thing, perhaps as a secondary thing. And I think that's quite a common way that people would think about ESG. And what I've tried to show here is that these are two very different things. You can see the scatter plot here. These are generally emerging market companies, with the exception of Royal Dutch Shell. On the x-axis here, you can see ESG ratings, and the ESG ratings, I'll just find the right page again. The ESG ratings at the bottom are ratings that our system has generated for each of these different companies. And on the y-axis here, you can see the future regulatory environment for each of the different countries that each of these different companies operates in. In other words, the x-axis is a virtue ranking, where Coal India is considered to be, a sinner, a bad company with respect to ESG because it's the level of pollution, the way it behaves. And the sort of, the further up you go in this space, the stronger the regulatory environment is for the company, for the country in which these companies operate. So Royal Dutch Shell operates in obviously countries where the regulatory standards that it's held to are much, much higher than, say, Coal India. But there's a balance between these two things. A highly virtuous company operating in a very, very strong regulatory regime is in a relatively good place. But a highly virtuous company operating in a very loosely controlled regime could be argued, in a very cynical sense, to be spending more money than it needs to spend on ESG virtue. And so what you tend to find is there's this sort of diagonal line here which represents where a company sort of needs to be, given how strong the regulation is in its local market. And that in many cases is where you tend to see companies managing their position to. In other words, they don't want to spend too much being overly virtuous if the standards they're being held to are weaker, and vice versa, if the standards they're being held to are stronger, then they want to be more virtuous. And that's what we tend to see overall. So tying these two things together is really important to understand actually what the investment risk is for the company. And I don't believe that we're seeing that with the current rating environment. And I do believe that this is something that AI and machine learning can contribute to, solve this puzzle. Excuse me. So just very briefly, we're going to touch on the nuts and bolts of big data and AI. And again, we can look at what a company says about itself, and this is an example from the Chinese market, also biodiagnostics. And we're not going to get into the details of the company, but we can look and see what the company says about itself. And one thing that AI can do is to work out if a company is actually addressing things that are important, materially important for the ESG profile of this company. And you can get machines essentially to scan through these reports and to look at the different themes. So it's important that for a company of this nature, that they should address product quality and safety, selling practices, product labeling, product design and lifecycle management, supply chain management. And indeed, this company covers almost all of those material topics it should do, 80%. And as a result, part of the story here is that it's got a relatively high AA ESG rating. But on the flip side of that, you can see, relatively poor performing companies. And this is the largest mining group in China. And you can see that of all of the different themes that it should be addressing, like greenhouse gas emissions, air quality, energy management, it's only addressing about 30% of those themes in its CSR reporting, and it's in its regulatory reporting. And part of the story that it has a relatively low rating. The point here is these are things that can be automated by machines, can absorb this huge amount of data, to drive deeper insights. So just tying up all of the things I've said, and there's been a lot of information here. We believe that AI and big data can be used to drive ESG ratings, investing, and analysis. And it's all down to these 5 points here. It's about ending the one-size-fits-all ESG. It's about harnessing and interpreting vast data resources. It's about being able to validate and correct complex information, measuring ESG investment risk, and I stress investment, and shaping the ESG rating around learned material themes for different industries. in short, we think that the future of ESG investing is not entirely a human one.
Thank you, Dan. We're going to come back, obviously, for Q&A at the end. So I'm just going to tee up the next lot of slides and introduce Daniel Bland. Daniel, I'm not going to say much else. I'll give you the intro earlier on, so hopefully everybody can remember who you are. Over to you.
Fantastic, thank you. And thanks everyone for taking time. I'm just going to share our experience with sustainable investing, and then how we approach that and some of the challenges we face, and sort of think a little bit about this from an advisor's perspective, and then the different type of investors that we encounter. Quick bit about EQ. So we're a founding UK B Corporation here in the UK. And for those that haven't come across B Corporation, really encourage you to take a look. It's a great way of setting up and running a business. We look after about 1.3 billion of assets. We're a relatively small wealth management firm, but actually our experience with impact investing goes back to 2008. And we believe we've probably got one of the longest track records in this space amongst a lot of our competitors out there. So, how do we think about sustainable investing to start with, and where does that sit in the broader scale of things? For us, we want to seek a financial return, as you would with any other investment strategy, if that's traditional, if it's ethically screened or ESG focused. The key thing for us, though, is that when we're making investments for our clients, we want those investments to be in companies or in structures that are helping contribute towards solutions to environmental and social problems. That means that we naturally avoid areas of harm. And actually, Dan's touched on some really interesting areas here. But for us, ESG, considering those risk factors and corporate behaviour is just sensible portfolio management. So we pay consideration to ESG factors as part of our overall investment process. But the real driver is thinking about investment in businesses that are solving environmental and social problems. So that's where we sit. But I just wanted to dive into ESG investing and data-driven investing in terms of index compositions. We've both picked on MSCI here. Actually, there are plenty of other, well, first of all, index providers, but also ESG rating providers. Something that's quite interesting is that another one of the big ESG ratings agencies out there is Sustainalytics. What you'll often find is that Sustainalytics methodology actually differs slightly from MSCI's. So if you had two comparable, if you had one company and then you looked at the comparable ratings, often they might actually end up being slightly different. There's a slight nuance in how the data is treated and the approach. So just looking at this slide, what we can see is on the left-hand side, we've got just a pure market cap weighted index of companies. And as we move along, the index compositions are affected by two different factors. The first is the consideration of the end product and service, actually, and but that's about not positively including but negatively excluding sectors. So first of all, if you start excluding out some of the most controversial areas, you're going to end up with an index that's covers about 93% of the companies that you would have with a market cap index. When you start looking at integrating ESG scoring and having relative over and underweights to companies based on that, you start reducing that number a little bit, but it doesn't change things clearly a whole lot. So you're actually getting an index that looks pretty similar to what you might achieve, but with just slightly different weights from that of a market cap index. Where things start getting more differentiated is when you start very much skewing your index composition towards ESG leaders, so those who meet a threshold in terms of a score. And actually, you can, with the SRI index, actually end up with a very much more focused set of investments that looks very different from the index. A couple of observations here. Every time you look at an index, you're generally going to be focusing on larger companies. And there's something interesting about ESG scoring, and that's that larger businesses have much greater resource to employ in really answering questions and providing that data for the ESG ratings agencies. So what you tend to find actually is that if you compare large versus mid or small cap, you'll tend to see that large caps will on average be able to achieve a slightly better rating, and that's really to do with the resource that can be employed by them. So that's ESG, and that's all focused on the corporate level behaviour, really, of the businesses. So I'll just touch now on our experience with different groups of investors and what the landscape looks like at the moment. From a retail perspective, it's really clear that investors are very interested with the idea of aligning their investments with their values. So stat here, which is that 70% of retail investors, when asked, say they want their investments to avoid harm and then achieve good for people and planet. And when we think about retail advisors, so financial advisors, a lot of them are having to step up the level of integration of sustainability or questioning in their fact-finding process and analysis, and how they implement that in their advice process, because the regulation's really stepping up to ensure that that's really integral in any advice that's given, and to be suitable, really now an advisor needs to pay quite careful consideration to retail investors' sustainability preferences. So the experience here generally is one of pragmatism. You tend to find a retail investor will be less interested in the relative merits of a corporate's behaviour from an ESG perspective, whether they've got good environmental practices at that corporate level. They're much more focused on what's that end product and service. What's the clear link with my values. And then moving on, thinking about pension trustees. Pension trustees already need to demonstrate that they consider ESG factors in investment decision making, and that's all about understanding that ESG factors have financial materiality, and for us, that's just a sensible way of approaching investment. Larger schemes actually already have to disclose their climate change related risks. That's a pretty big deal, and that's potentially that could be rolled out further to smaller schemes, and then rolled out further for perhaps looking at larger charities as well. So in our experience from that side of things, a pension trustee will be much more comfortable with an ESG focused strategy, and perhaps they'll start looking at carbon emission metrics and integrating that into the approach that they take as trustees. Charities. So charitable trustees, there's a bit of a lack of clarification about how far lots of charities can actually go in terms of looking to achieve positive outcomes for society and environment with their investments. And there's some work that's being undertaken at the moment to clarify how far that can actually go, and that's due to be published in summer of this year. What we're finding in our experience is that there's a real groundswell of investors here who want to make sure that whatever they're invested in, that it's firmly aligned with their aims as a charity, and where that's not necessarily possible, that any investments that they're making have a positive effect on society and environment. And that's from a values perspective, and it's also just thinking about your donors and potential donors. who really are paying quite close attention to this as lots of data becomes much more available and people can pay closer attention to it. So that's the general feel of things. And then I just wanted to touch on something that's pervasive across all groups, and that's that there's a much greater understanding that sustainability and good environmental, social and governance factors really are demonstrated to have a link to positive financial outcomes, and that's across asset classes. And thinking about end products and services here, actually investors are very much aware of the fact that consumer preferences are changing, government legislation's moving very quickly, and we're entering an environment now where lots of capital is being directed by governments and central banks towards decarbonising economies and towards creating more sustainable economies as well. So from that perspective, there's a very interesting growth opportunity here. And I guess an interesting example that covers lots of different investor types as well. So even some big pension schemes like HSBCs, that's very much taken the view that investing in sort of greener investments is going to benefit them from a financial perspective, as well as having a key being additive in terms of the values and having a clear approach to that. So there's a lot at play here, and there's a lot of opportunity at play here. And now I just want to take a quick moment to think about data, and then how we use data and what's really important to us and for our investors. What we do each year is that we undergo a really significant exercise which forms the backbone of our data gathering. We use lots of different sources, and some of that's automated. To your point, Dan, although we do employ quite a lot of manual work as human analysts as well. And we create data sets that allow us to report on impact in the same way that we report on financial returns. And we think that both are just as important for our investors, because you can't claim to be having a positive effect on society and environment if you can't back that up with some really clear data. I'll just start with one really, for us, key part of having a sustainable approach to investing, and that's engagement. And this is something that something that's very difficult to quantify in the way that you can with ESG scoring or thinking about positive social outcomes, for example. When you're investing in liquid main markets, one of the best ways that you can have a positive effect on society and environment is by exercising your right as a shareholder to vote and to create change at a corporate level. Because actually, if you think about how a lot of capital that's within the secondary markets recycled, it's quite different if you're investing in private markets, where often you'll be providing primary capital to businesses where you have much closer relationships with management teams. So here, the engagement piece is really important. And for us, we report at the moment around 4 key engagement themes that we undertake, and we use a milestone-based approach to outline the different stages that we've reached with our engagement. Thinking about the products and services of businesses and how that they can have a positive effect on society and environment, we use the UN Sustainable Development Goals as a framework. Dan touched on this earlier. It's since they were brought to the fore in 2015, have been really very helpful. So there are 17 high-level goals and then 169 sub-level goals, but we've just focused on those those top-level goals here. And really, what this means is that we're focused on businesses that have a product or service that's aligned with the UN Sustainable Development Goals. It means naturally we avoid those that are detrimental to those or have some harmful effects. We do have some investment in businesses that are neutral, but actually might have quite interesting corporate level behavior that has an impact. How do we do this? We use measures of revenue, and we have thresholds in place to look at how material that revenue contribution is to a sustainable development goal. And using our data set, here we can see FTSE 100, MSCI World, and how our data set aligns from a SDG perspective, and then our positive impact equity strategy at the bottom there. Clearly you can tilt a portfolio and focus very much on those sustainable things. Something well, we're finding that there's much better data sets now, although there's a lot of room for improvement, but is actually really very important both from a values and an investment perspective, and that's carbon intensity of investments. So we've got two graphs here. The right-hand side, we're looking at fossil fuel reserves, and for us as investors, removing that values piece, we see the potential for there to be material financial risks in holding highly carbon intensive or potentially highly carbon intensive assets within companies or investments that we're making, and our portfolios don't have fossil fuel reserves within them. And that ties into a really very big structural trend towards decarbonisation. If we think about the net zero targets, which even China now is heading towards by 2060. On the left-hand side, we've got corporate level CO2 footprints, and that's thinking about all of the various scopes of carbon emissions, both internal to the business and then to the product and service that's produced. Clearly, we want our portfolios to be less carbon intensive than the wider universe of investments. Again, both from a investment risk perspective, when we think about this trend of decarbonisation, but also from a values perspective. But in its own right, having a couple of bar charts like this doesn't give a whole deal of context. What we want to do when we're thinking about carbon emissions is think about climate change risk. And what we've got here is a chart that shows the various warming scenarios that we might experience. At 1.5 degrees of warming is a best case scenario globally, and that would limit some of the worst damage that climate change could cause and create material financial risks in doing so. So with our portfolios, we want to ensure that there's those emissions stay aligned with a 1.5 degree warming scenario. So it's not about maintaining a static level of emissions. And just lastly, this is very much focused on a sort of values side of things and being able to demonstrate the impact that's achieved through investment. We look at corporate reports and accounts, and we draw out where they're reported, and a lot of companies just don't report on this. We look at the social and environmental metrics of positive effects on society and the environment, and we aggregate those up and create portfolio level scores effectively of reporting for social and environmental impact. And that's our perspective. So I guess we'll probably be looking at questions now.
Thanks, Daniel. Really good and informative presentation. I think I've got everybody queued up and mics on. So Adrian, over to you to chair the Q&A. We might run a little bit late. If you guys are happy to stay on just a few minutes after one, that'd be great. As long as you haven't got anything to dash off to, we can run it a few minutes past 1 o'clock if needs be.
Lovely. Thanks, Andrew. Thanks, Dan. Thanks, Daniel. Just a few remarks from me to give you a chance to get a breather as we go into questions. I just wanted to say that, not only is ESG very much front of mind for everyone right now, but what I'm certainly observing is that the pace of change is quickening quite dramatically. It kind of started in 2012 with Professor John Kay's report on equity markets, followed rapidly by the 2014 Law Commission report addressing investment intermediaries And the Law Commission, of course, told us that we should take into account ESG issues where they are financially material to the risks and returns of the investments, and that we may also take into account wider issues where they may be of concern to beneficiaries and where doing so does not risk significant financial detriment. And we've seen a slew of legislation since then, most recently Pension Schemes Act 2021 this year. Of course, that's moved the dial further. Those words should and may are increasingly becoming must. So, for example, from October of this year, symbolically just ahead of Glasgow hosting the 26th UN Conference on Climate Change, COP26, the law will require our largest pension schemes and master trusts to publish a report on how they're meeting their climate change obligations. And where large institutional pension schemes tread today, we can feel pretty certain retail investment schemes will be following tomorrow. We are covering all of E, S, and G today. I sense it's relatively easy to make announcements on E, in that they're generally greeted with much public acclaim. So this month, for example, the state-owned pension scheme Nest has announced that an initial £250 million of its members' money will be invested into renewable energy with Octopus, with a plan to increase that further to a staggering 1.4 billion. Earlier this year, Aviva announced their ambitious net zero plans to see all of their investment portfolios achieve net zero by 2040, and their own operations and supply chain, so that might be, you remember, achieve net zero by 2030. Many of these E announcements are well published and well covered. Those of us seeking to invest in companies with green credentials should hear all of this, even if the noise level being high may make it difficult to extract the most important signals out of all the shouting. But for S, the social part of ESG, that often goes underneath the radar. It required a leak for the survey of working hours at Goldman Sachs to get out and expose this week that junior staff there are working 95 hours a week, and that the bank regularly breaches its Saturdays off policy. People are using the words modern day slavery in the same sentence as referring to those sort of hours that Goldman Sachs staff are asked to work. And again, the remarks by KPMG chief Bill Michael to his staff to stop playing the victim card that led to his abrupt exit from KPMG were again supposed to be confidential and weren't supposed to have sneaked out. So you may have to look much harder to find data on S. But that change of pace, I think, is also increasing for S, the social factors of ESG. The demonstrations on Clapham Common have shown that huge numbers of people no longer believe it's acceptable for women to have to live in fear of abuse by men. The reactions to George Floyd's death in the United States have shown a worldwide condemnation of racism. And just this morning, DWP have launched a call for evidence on the social factors as an investment consideration. Meanwhile, the third leg, G, for governance, is probably the most advanced. But that doesn't mean we tick it off as job done. It simply means we're on a different part of the curve of progress. So for G, we now have readily available metrics. Increasingly, companies that we might invest in are publishing statistics around gender pay gap and diversity of boards of directors. But as investors, having the data is one thing, understanding how to act on it is another. The best investors will keep looking, keep probing, and keep asking for more context around the metrics. Those that can understand the data and metrics better will earn better long-term returns. Hopefully what you've heard from Dan and Daniel already this morning will help you help your customers. Now, if I turn to a number of questions that have come in, if you've seen the question board, you have the chance to vote on them. A number were emailed directly to me over the chat, so I have put them on there, which is why it looks as if I'm asking nearly all the questions. I assure you I'm not. They've come in from other people. A quick one that came in was, are we happy to share the presentations at the end of the deck with people? So I just quickly asked both Dan and Daniel if we were to pop up a link to people to download your presentations. Would you both be happy with that?
I'll check with compliance, but that sounds good.
Lovely. Okay, we will check, but we will hope that we can. Dan, are you okay on that?
I'll have to discuss it afterwards, but quite possibly, yeah. I can post a list of references for the graphics that I've got in there, if not.
Okay, thank you very much, both of you, for that. Audience, we will come back to you on that. But compliance willing, yes, that we will find you a way to link and obtain those presentations. So turning to actual questions that have come in, I'm going to take them in the order, the ones which have got the best votes, because they're clearly the ones that are of most interest to you. So our first question is, how does a retail investment fund find the right balance between ESG factors that pose a financial risk to the assets against those that are the ethical convictions of the investors? Dan or Daniel, can I tempt one of you into that one, please?
That's definitely Daniel's question.
Yeah, thanks. I think that's I mean, it's a great question, because the values piece is really very complex, and I think that there are really two sort of, in fact, there are three different types of investors that we encounter who are interested in sustainable investing. And then there's a whole sort of spectrum that exists between all of them, but, they sort of cluster around these different points. And I'll explain what those are. But the question really is, if you create a product, you're never going to be able to meet a product solution that fits for all of those. And I think that goes into the question about greenwashing. If you create a product, you need to just be really very clear about where that sits in terms of sustainability, provide the data, provide really clear impact reporting, an analysis of alignment with sustainable development goals. So when a sustainably minded investor goes to look at a product rather than something that's put together for them, they understand what they're getting, and they really see it. Don't just label it ESG green something and then you fall foul on that front. The three types of investors tend to be those that have real intentionality to achieve change with their capital. So they're very almost evangelical in the way they think about sustainability and the sorts of things that they want to achieve with their money. You then have investors who are more do no harm. I don't want to do anything harmful with my investments, but they're still very much sustainably minded. But actually, in terms of how you might build a product or portfolio that meets both of those investors' needs, I think they would be quite different. And then the third category sits actually a little bit outside the whole values piece, and that's an investor who would look at the opportunity set from some of the big trends that we're experiencing. And it's so easy just to focus on green trends and environmental issues, but I'm going to, because it is easy. But thinking about decarbonisation and the whole effect that's going to have on supply chains and asset values is very significant. And actually, you can invest in businesses that are very fast growing and innovative that are solving some of the problems that we're all facing and changing consumer habits and government preferences and so on. So that's a third type of investor. And I think they might even have a different product that you'd create for them. So hopefully that answers the question in a roundabout way.
Yeah, no, thanks very much for the input on that. Moving on to another one here. Now, we had greenwashing in the title of the seminar today, of course. And so I've had a question sent in. How rife do you think greenwashing is, with companies pulling the wool over our eyes with overclaimed ESG improvements? And at what point should we consider a product to be greenwashed? Dan, could I ask you to start on that one, because you did reflect in your presentation that not all of the information which is out there is accurate.
Yeah, I think there's a lot of greenwashing going on out there. But again, is it people being untruthful, or is it just the subjectivity of ESG itself? It's probably a combination of the two. So the accuracy of the data out there is sketchy. There are lots of holes in the data. People aren't necessarily reporting all the information that they could report. And I think it's very difficult to get a handle as a human analyst, to get a handle on exactly what's being done and what isn't being done by a particular company to achieve better outcomes for its investment risk profile relating to material themes of that particular company. So what we found is that the machine learning, the AI, using big data, as I was saying, I gave the example of two Chinese companies learning from what a company doesn't say about itself as much as from what it does say. If you're using all of these different techniques and you're cross-referencing and cross-validating that information with what you're reading on, sources like Baidu or news, NGO comments, as I was mentioning earlier, then you've got a fighting chance of being able to pin down what the ESG profile is of that particular company, and then whether that ESG profile fits your beliefs of what ESG are and your asset owner's objectives. And that's the key here. It may not be about untruthfulness, but it's about subjectivity and this game of whispers as we sort of go down the food chain from asset owner to the actual companies in which we're ultimately investing in. So it's all of these disconnects. And I think AI and big data is a way of being able to manage those disconnects and maintain asset owner objectives right the way through that food chain.
Thanks, Dan. Yes, I seem to recall that dog that doesn't bark was an old Sherlock Holmes trick for getting to the bottom of a mystery that has foxed other people. Daniel, anything to add on greenwashing?
I think that Dan's comments on data is just really on the mark. There's such a mixed bag in terms of consistency of data, the methodology, so on and so forth. We're often asked with the environmental impacts that we're reporting for investors. It tends to be corporate clients actually. You're showing me that we've produced, however much renewable energy. We've added some renewable energy capacity to the system. Can I use that data to then offset my carbon emissions as a business? And what we, there's a danger of showing this sort of data, but not being very clear about the fact that actually we would say absolutely not, because the data we've got here is taken from reports and accounts, but often you find that because you're so far back, you're so far removed as investors from that data, the link and the tangibility of carbon offsetting is very, it's very far away from the mark. Final point, there's some interesting regulations being put in place within Europe, being consulted on here in the UK, which is looking at categorizing products. And I think that's going to go a long way to help stop some greenwashing. So there's 3 category types that are being put in place.
Thank you very much for that. We shall look forward to seeing those come through. Next question by popularity is asking us whether by aligning a portfolio to a particular climate scenario, do we feel this restricts the ability for returns? Which of you would care to have a view on that, please?
I might start because I included that. That's our thing. So it's a very good question. It's an important question. And well, first of all, if you just leave the sort of values piece aside, you think about this from a risk perspective. Decarbonisation and the trend towards first of all, we need to decarbonise. Governments have legislated for it, and huge amounts of money is being spent to decarbonise economies. There's a real material risk that by holding more carbon-intensive assets, you could be exposed quite badly to that trend. Our experience with our portfolios being lower carbon than the rest of the market actually is that performance is very strong, and we've really, performance is excellent. I might caution though, there's a period over perhaps the next year or so where we might see a level of, during the recovery that we're going to experience, where there's a danger that rates might creep up, although central banks are saying no. Inflation might creep up. What we might see is a period of underperformance of some of those faster growing companies that are involved in solving decarbonisation problems or involved in that wider growth area. So I think, over the next year or so, you could see some underperformance in those sorts of strategies, depending on what the inflation and interest rate outlook looks like. And oil might actually, there's lots of bullish notes out there from banks. Oil might recover very well because supply's been cut. But for our investors who are thinking over 5-10 years time plus, at least, the risk for us is still very much there, and that's very a short or medium term effect.
Oh, thanks so much, Daniel. I mean, I think that distinction between the short term and the long term is so important in the ESG, and I think the vast majority of the people that are Dunstan Thomas clients are pension fund investments. There's really nothing much longer than a pension fund investment. Is not trying to guess what's going to be red hot next month. It's trying to position the investments in such a way that over the 30-40 year duration of a pension fund, the right ones will come through. I'm just looking quickly at the rest of the questions because I know that we are a little bit running short on time, but I will ask one more, which is really about how much detail do investors want? Do they want a one-dimensional scale, rather like the sort of 1 to 100 scale that's used by Robert Parker for wine or age-wage for rating pensions? Or do they want multi-dimensional scales showing different scores against several different factors?
Well, I mean, I can answer that sort of generically. I think investors want to see a really concise, explainable way of presenting ESG risk that they can understand that relates back to their own objectives. And this is really challenging, as the question implies, because there's so much information out there. How can you distill all of this into, a single figure or a rating scale accurately without, with consistency and with some objectivity? And it's extremely difficult. The way we're sort of thinking about this is that, firstly, you need to understand very clearly what your investor objectives are, and sometimes that's possible, sometimes that isn't. In the institutional world, you would hope that it's possible, and you can define those quite clearly. Subjective ESG maybe, but you can objectively define those aims, and then you can present that information in a pretty concise way. If you're in the sort of one-size-fits-all ESG world, you're going to have an opaque rating or some sort of a risk metric. It's very difficult to get away from that. Else you'll be displaying huge amounts of information, which as we discussed, can be flawed, can be have gaps in it, have all sorts of other issues. So it's certainly something much easier in the institutional world than it would be in the resale world.
And nice segue for my part, where most of our clients are retail. We do work with some institutions. Retail investors actually are quite varied, and some do like a lot of detail, but just in general, a retail investor will want a more straightforward analysis of what they're invested in. It's simply due to the fact that while they may be capable of understanding all of this, it's just not their area of expertise. Whereas with institutional investors, where you might be working with trustees, clearly it's their job to be much more aware of all of the factors and understand them.
Brilliant. Well, thank you very much to all of you that sent me questions. I think it's a good point now for me to close questions and hand us back to Andrew Martin, our compere. So, Andrew, back over to you.
Thanks, Adrian, and thanks both Daniels. Really good session. Loads and loads of content. I know we probably could have filled another hour, but really appreciate your time and everything you put into some really useful content and answering the Q&As. For everybody who's still on, and that's the majority of people, interestingly, so it's obviously kept people engaged. The next topic is on small self-administered schemes. There's a link at the bottom of the page to give you more detail and to register. And if you do have any suggested topics for future webinars, then please mail the info@dunstanthomas.co.uk mailbox, and we'll consider all suggestions. Thanks again, everybody, for attending, and thanks to all our speakers. Bye now.